Hello. We're going to talk about inventory and a couple of things. You have received some emails from me, one of which is your midterm answer sheet solutions. And I also posted out there the ink solutions on the midterm itself. In addition, you have received the solution to the accounts receivable or bad debt homework, and these are copies of the two emails that you have received. The next homework is due January 31st at the start of class. So today we're going to talk about inventory. Inventory can be very expensive and unique, such as diamond rings, or it can be a commodity like jelly beans or sardines or tulip bulbs. They can be very expensive, meaning they're accounted for with specific identification, such as jet airplanes or cars that have VIN numbers, or they can be treated like commodities, and we just look at the flow of the items rather than try to identify each and every one. So, what's the key question? How much does it cost? It costs what it originally cost, and that's its input value, or there are some that you can value instead at what it would cost to replace it. In either case, we always value inventory at the lower of its cost or its current market value. So a lot of times we'll mark inventory down to the lower of cost or market. Because of inventory, we're thinking about income tax ramifications, cash flow ramifications, how much it costs to actually maintain and keep inventory, and then some of the issues and the quirkiness that comes up because we have inventory, such as LIFO liquidation or how it impacts our ratio analysis. Well, disclosures. Coca-Cola, first thing to remember, inventory is a current asset, so it will always show up as a current asset until such time as it is sold. And when it is sold, it goes into an account on the income statement called cost of goods sold. And if you are having a multi-step income statement, you can look at the difference between what you sell it for, the revenues, minus its cost to find out what the gross profit is. Inventory will vary depending on the type of company it is. Because Coca-Cola is a manufacturer, when you look at the notes to the financial statements, you notice that it has to disclose the types of inventory it has. And since they're a manufacturer, there's three kinds. There's the raw materials or the material inventory, the work in process, meaning as it's making the Coca-Cola products, and the finished goods, which is the syrup and that Coca-Cola sells to its distributors. Notice you also have to make disclosures about the type of inventory method you use. Notice Coca-Cola uses average cost or first in, first out, also known as FIFO, and that it must value at the lower of cost or market. Contrast this with Walmart, which has, yes, inventories. Because it's a retailer, notice how large inventories are relative to its other current assets. And when those inventories are sold, they go into an account called cost of sales rather than cost of goods sold. Notice that Walmart uses the single-step method. There is no gross profit or gross margin subtotal. All the costs are added together, expenses, compared to the total of all the revenues. Walmart, on its cash flow statement, has to disclose the change in inventory because remember, inventories is a current asset. And because of that, its change impacts the net cash provided from operating activities. In Walmart's footnotes, again, notice it must disclose the lower of cost or market. And notice that Walmart uses LIFO, or last in, first out, in the U.S., but abroad it uses FIFO, first in, first out. And if you use LIFO, you also have to disclose the change in inventory, also known as the LIFO reserve, between if you had used FIFO instead of LIFO. And notice that Walmart says they're approximately the same, and that's because Walmart uses just-in-time inventory systems. In other words, it doesn't keep inventory itself. It would rather have its suppliers deliver inventory on a as-needed basis. So what do you include in the cost of inventory? You include the cost of the inventory itself, its invoice price, plus any freight that the buyer pays to bring the inventory to where it's going to sell it from. You subtract out any returns, any allowances on that inventory given to you by the seller. You subtract out any discounts that are received from the seller because you either bought in bulk or because there was an early payment. A couple of terms you need to be aware of. When a buyer pays the freight, it's called freight in or transportation in, and that's because the terms are FOB shipping point, which means the title to the goods passes when the goods are put on the truck or whatever, when they're shipped to the buyer. Because the buyer owns the goods while they're on the truck, the buyer pays the freight. Contrast that with when the seller pays the freight. It's known as FOB destination. We know it as free shipping. It's called FOB destination because the title to the goods does not pass until the goods are delivered to the buyer. If we're talking about inventory that is manufactured, there are three major ingredients. They're called materials, labor, and overhead. Overhead includes all those indirect materials and labor, plus other production-related costs that are not directly traceable but must be allocated to the products. When we look at inventory, there's two major approaches. One is the perpetual approach. The perpetual approach is used with companies that have computers, barcodes, RFID tags, scanners. They have one account called inventory, and that inventory tracks all the inventory costs until such time as they're sold or returned. Under periodic, though, you have two accounts. One is inventory, and the numbers that you find in inventory are as a result of taking a physical inventory, and that's the actual physical inventory that you have. And then you have a separate account called purchases, where you track your purchases or your buying of inventory during the period. At the end of the period, notice that under periodic you must compute cost of goods sold. So it's the physical inventory that you took, plus everything you bought, plus any freight, gives you the cost of the goods available for sale. Subtract the physical inventory that exists at the end of the period, and the difference must be the cost of the goods you sold. So, for example, for HP, at the beginning inventory is 7.5 billion, ending inventory is 6.3 billion, and we know that cost of goods sold is 59.5 billion. If that's the case, we can either use the T account approach to figure out how much inventory HP bought, or we can use the computation approach to figure out how much inventory HP bought. So this is just a way to take a story problem and put it into your template for success. When we talk about cost of goods sold under perpetual, remember that's where you have the computer. You have an account called cost of goods sold, whereas under periodic, again, you must compute cost of goods sold. Now, using that computation again, beginning inventory plus purchases gives you the goods available for sale, minus ending inventory to give you cost of goods sold. You can do that over time. So starting in 2010, beginning inventory plus purchases gives you the goods available for sale. If you know what cost of goods sold is, you can find ending inventory. Ending inventory always becomes beginning inventory for the next period. Because we know goods sold in ending inventory, we can find goods available, and so we can back into purchases in 2011. In 2012, since we know the ending inventory in 2011 becomes the beginning inventory in 2012, and we can solve for all the unknowns. This is another problem that's similar. What's different about this one, whether you do it the computation or the T-account approach, is notice it says that the account shows an ending balance of 52, but when we took a physical inventory, there's only 50,000 on hand. So how can you have an account that shows 52 and physically you only have 50? Well, the difference, or the $2,000, is shrinkage, meaning they broke, they were stolen, there was something happened to those other $2,000 of inventory, and that's known as shrinkage. So we have cost of goods sold, but we can also have shrinkage in our computations, especially if there's a difference between the physical count of ending inventory and what the account says. So what are the journal entries under the periodic method? When you buy it, you debit purchases or inventory, credit accounts payable for its cost. There is only one entry made at the time of sale, debit accounts receivable, credit sales for the selling price. And then at the end of the period, remember you have to compute your cost of goods sold, which is the beginning inventory plus the net purchases minus your ending inventory gives you your cost of goods sold. When we have credit terms such as 2, 15, and 30, that means you get a 2% discount if the buyer pays their bill within 15 days of invoice, but the full bill is due within 30 days. So here, Nick purchases Maine lobsters on October 10th, debits inventory or purchases, credits accounts payable for the gross amount. He also buys Alaska king crab on October 11th, debiting inventory or purchases, crediting accounts payable for the king crab's gross price of $36. Because Nick paid for the lobster within 15 days, October 20th versus October 10th, he only has to pay 98% of the bill. So he'll debit the 100% of the bill to get the $76,000 bill off the books, credit cash for 98%, and credit either purchases discount or inventory for that 2% cash discount because he paid his bill early. Contrast that to the crab, which he paid after the discount period had lapsed, so he has to pay the full bill of $36,000. Debit accounts payable, credit cash. Now, when we deal with the periodic method, we talked about that we have to compute cost of goods sold. So just as a reminder, net purchases includes the purchases, the full amount, minus any purchase returns, minus any of those discounts, plus any freight in. Now, here's the dilemma. When we deal with inventory, we have good hard information, good hard evidence for what the beginning balance number is and what the net purchases number is. But then we have to come up with some way to allocate that total between the ending balance and cost of goods sold. And how we do that is we can track it by specific goods like diamond rings or jet airplanes, where we specifically identify which item is being sold, or we use average or weighted average method, or we can use the FIFO method, which stands for first in, first out, for valuing the cost of goods sold, which means the last ones in are the ones still here for valuing the ending balance. Or the third method is LIFO, last in, first out, for valuing the cost of goods sold as far as the flows of the costs, and first in, still here, for valuing the ending balance. So in your homework, you'll be doing the average, the FIFO, and the LIFO under periodic. Here's the facts. So in the first year, since it's a brand new business, we purchased 10 units at $10 and 20 units at $12. So we have available for sale 30 units at $340 cost. That's the cost. We're going to sell 15 of those units at a price of $30. So here's the sales, and we have to now figure out how much of this cost should be assigned to those 15 units sold. In the subsequent year, notice we have 2 more purchases. So here's how it goes. In 2013, we have available for sale 30 units at $340. We know we sold 15. If I'm using FIFO, the first units to come in are the first units sold. So if I sold 15, I sold the 10 units at $10, plus I sold an additional 5 units at $12. So the value that I will assign to cost of goods sold is $160 for those 15 units sold. Well, what's left? Last in, still here. Of the $12 layer, I sold 5 of them, so 15 units remain at $12. So ending inventory will be assigned a value of 15 units at $12 or $180. Sun goes down, sun comes up. 2013 becomes 2014. Ending inventory for 2013 becomes beginning inventory for 2014, 15 at 12. During 2014, we buy 2 more layers of inventory. So in 2014, we have 40 units available at a total cost of $535. We now have to assign that $535 to either ending inventory or cost of goods sold. FIFO says the first ones in are the first ones sold. If I sold 20 units, I must have sold the 15 at the 12 and another 5 of the $13 layer. So cost of goods sold will be assigned $245. Sorry. Ending inventory, the last ones in are still here. So I have 5 remaining units at 13 plus the 15 at 15. So the ending inventory will be assigned $290 of costs. That's FIFO. LIFO. LIFO, same facts. First year, brand new company, just starting out. We have 30 units, total cost of $340. We sold 15. Under LIFO, the last ones in are the first ones out. Now, that's not how we stock our shelves, but that's how we assign for the costs. And we'll talk about why the U.S. loves LIFO so much in a second. So, if they're the last ones, they're the $12 layer. So I sold 15 at 12, which means ending inventory, I have 5 more of the $12 layer, and I still have all of the 10 of the $10 layer. So $180 is assigned to cost of goods sold, $160 is assigned to ending inventory, Notice we have to tie back to that $340. And because ending inventory is made up of two layers, beginning inventory in 2014 is made up of a 10 at $10 layer and a 5 at $12 layer for those 15 units in beginning inventory. We then purchased two more purchases. So in 2014 we have 40 units available for sale at a total cost of $515. We sell 20 units, last in, first out. The last ones in were 15 at 15, so we sell those. We need another 5 units at $13. So we'll assign $290 to cost of goods sold. The difference, or $225, will go to ending inventory. To prove that out, if I'm under LIFO, ending inventory is fish. First in, still here, so the 10 at 10 are still here, the 5 at 12 are still here, and the 5 at 13 are still here. So notice we all have to tie back. So this is LIFO. The last method under periodic is average cost or weighted average. Same facts as before. 2 purchases in the first year, meaning we have 30 units available at $340. So the average cost, Cogas dollars over Cogas units, is $11.33 is the average cost. So the ending inventory and the cost of goods sold are both valued at $11.33. Rounded to the nearest dollar. Notice we must tie back to the 340. Ending inventory for 2013 becomes beginning inventory for 2014. So 15 at 11.33. The 2 purchases in 2014, meaning we have cost of goods available for sale of 40 units at $525. Taking Cogas dollars, $525, dividing by Cogas units of 40, we see that the average cost in 2014 is $13.12.5. So ending inventory and cost of goods sold will both be valued at $13.12.5. So let's compare now these methods. In 2013, we knew that the sales were $30 selling price times 15 units. The cost of goods sold, notice we come up with different numbers. Revenue minus cost of goods sold gives us gross margin. Notice that for LIFO, because costs were increasing, that the last ones in, the most costly goods, showed up in cost of goods sold. Thus, cost of goods sold is the largest number under LIFO because costs were increasing. So if cost of goods sold is the largest number, that means gross margin will be the smallest number, and net income also will be the smallest number under LIFO. Notice for FIFO, the opposite is true. The cheapest costs, the first ones in, the cheapest costs, were found on the in cost of goods sold, so FIFO gives you the largest gross margin and the largest net income. Also notice for FIFO, it has the largest number on the balance sheet. So inventories, because it has the most current costs on the balance sheet, its current asset valuation will be higher using the FIFO method than the LIFO method. Notice the LIFO method, inventory valuation on the balance sheet, those current assets, is the smallest number. So as you can see, your choice of inventory method and whether costs of inventory are rising or declining will have a big impact on your bottom line on your income statement and how much taxes you pay, and also on how large your current assets are on your balance sheet. Notice that weighted average always falls between the two. So that's periodic. That's no computer, no RFID tags, no scanner. The more common method used today is perpetual, meaning you have a computer, you have a scanner, you have RFID tags and barcodes. When you buy inventory this way, you debit inventory, you credit accounts payable for its cost, and then when you sell it, there is not one but two entries. The first one is to record the selling price, debit accounts receivable, credit sales, but the second one is to debit the account, cost of goods sold, and credit inventory for the cost as it's determined by either you using the FIFO method, the LIFO method, or the average cost method. Again, if you have credit terms like 215 and 30, you record at the gross amount, and if you pay within the discount period, you get to pay less because you paid within the discount period. Same problem as before. When I look at inventory accounts, remember under the perpetual method, we have one account. That one account tracks all your inventory and all of its doings until it is sold, whereas under the periodic method, inventory is only touched when you take a physical inventory and you have to compute cost of goods sold and use another tracking device for your purchases, which shows up in a purchases account. Cost of goods sold under perpetual is an account. Periodic, you compute cost of goods sold. So same problem as before. It's very similar to your homework. Notice again we have a purchase of $10 or 10 units at $10 because it's a brand new company. We then sell 5 of those units at a sales price of $30. We then make another purchase of 20 units at $12. We sell 10 of those units at $30. And then in 2014, we continue on and we purchase another 10 units at $13. We sell 10 units at $35. We purchase 15 units at $15. We sell 10 units at $35. So notice this is very much a chronological order, and we account for our inventory chronologically. And this is how we do it. We're going to do it FIFO and LIFO, just like your homework. In 2013, so we have a date column, we have a buy column, we have a cost of goods sold column, and we have a let's track our ending balance and inventory column. So in 2013, we buy 10 units at $10, so inventory at that time has 10 units at $10 in it. We sell 5 units. Under FIFO, those 5 units would come out of $10 layer, so we sell 5 at $10 or $50. That's where we debit cost of goods sold and credit inventory for $50. So after making that sale, we only have 5 units left in inventory at $10. We then went out and bought $20 units of inventory at $12. So now we have 5 units at $10, 20 units at $12. We sell 10 units. Under FIFO, the first ones to come in are the first ones sold. So we sold the 5 units at $10. And we sold another 5 units at $12, which means we have 15 units left in inventory at $12 at the end of 2013. So the ending balance is $180. To get cost of goods sold for 2013, you have to add up the cost of the two different sales. 50 and 110 is $160 was cost of goods sold in 2013. Ending inventory for 2013 continues on. In 2014, we buy 10 at 13. So now we have 15 at 12, 10 at 13. We sell 10 Under FIFO, the first ones in, the $12, are the first ones sold. So we sell 10 at 12, meaning we still have 5 left at 12 and 10 at 13. We then went out and bought 15 at 15, so now we have 3 layers, 5 at 12, 10 at 13, and 15 at 15. And at the end of 2014, we sell 10 units. Since we're under FIFO, those 10 units are 5 at the $12 layer and 5 at the $13 layer. And so we have 5 left at 13 and all of the 15 at 15. So the ending balance in inventory at the end of 2014 is $290. And the cost of goods sold is the sum of our two costs of sales. 120 plus 125 are 245. Sorry. That's FIFO. Doing it again under LIFO. LIFO, remember, is last in, first out. So we started 2013 with a purchase of 10 units at $10. We sell 5. Last ones in were the $10 ones, so we sold 5 at 10. We have 5 left at 10. We went out and bought 20 more at 12. So now we have 5 at 10, 20 at 12. When I sell 10 more at the end of 2013, the last ones to come in are the $12 layer. So we sell 10 at 12. So what's left? The old ones, 5 at 10 and 10 at 12. Because we started with 20, we sold 10, we have 10 left. Ending inventory under LIFO for 2013 is 170 units. And adding up our cost of our sales, it comes to 170 as well. In 2014, we went out and bought 10 more units at 13, so we now have 3 layers, 5 at 10, 10 at 12, 10 at 13. We sell 10. The last ones to come in were the $13 layer, so we sell those, and we're back to our 5 at 10, 10 at 12. We go shopping and buy 15 at 15, back to three layers. We finally, at the end of 2014, sell 10 units. Last ones to come in are the $15 layer, so we sell 10 at 15. So at the end of 2014, we're left with the 5 at 10, 10 at 12, and 15 minus 10 is 5 at 15. So ending inventory is 245. Adding up our cost of goods sold comes to 280 for 2014. So to recap again, notice that LIFO gives us the largest cost of goods sold, the smallest gross margin, and the smallest net income, and the smallest ending balance on the balance sheet. Whereas FIFO gives us the smallest cost of goods sold, the largest gross margin and net income, and the largest ending balance on the balance sheet. And that's because the cost of the inventory was rising. So to summarize, LIFO is used because it puts our current costs onto the income statement, because immediately if a company sells something, they have to turn around and they have to buy it again. So they do it for matching. But notice that this matching may not be the best method theoretically, but in the United States we love it because it means we're able to pay less taxes and keep more cash in our pockets. Now, we talked about if we use LIFO, we have to disclose the difference between using LIFO and using FIFO, and that's called the LIFO reserve. And that FIFO's advantage is that it gives you the biggest net income and the biggest current asset valuation for inventory in the time of rising prices. Weighted average falls between the two. Now, when I have the LIFO reserve, if I'm interested in the impact of that LIFO reserve, I can take the LIFO reserve times 1 minus the tax rate, and that is the amount that total assets are lowered by because of using LIFO, and I can use that same reserve times 1 minus the tax rate, and that's how much retained earnings are impacted as well. Net income is impacted as well. So there's a way to crosswalk between LIFO and FIFO, and that is very important because if you're trying to analyze a company and one uses FIFO and one uses LIFO, you can't really do proper financial ratio analysis because the inventory method can have a huge impact on the results of analysis. So to bring this into perspective a little bit more, GE, when it used LIFO, showed a value of $15.4 billion. It had a LIFO reserve of $398 million. So if you take the inventory valuation on the balance sheet plus the LIFO reserve, you get a pretty good feel for what FIFO would look like on that balance sheet. So then you can do financial ratio analysis and so on. So that hopefully helps. Now, we talked about that regardless of whether I'm using periodic, perpetual, LIFO, FIFO, or average cost, if after figuring out what the cost is, you look at the item and you say, oh my goodness, look, the price tag is less, then you need to write down your inventory to the lower of its cost or market value. And to do that, you debit cost of goods sold or loss on inventory write-down and credit inventory. And the reason we do this is because we're conservative and we always like to tell bad news early, as soon as possible. Here's an example of a company that took what we call the big bath. In other words, they took a big write-down. And a lot of times companies, when they change management teams or change product focus, will take these big write-downs. So notice in the year of write-down, they said, oh, inventory is worth $12 million less because it's obsolete, we're changing, we just don't need it anymore. So in Part A, how we wrote it down in year 1, we debited the loss, which shows up on the income statement, and we credited inventory, which made our current assets go down. But in the subsequent year, we were able to sell this inventory we had written down to $40 million for $48 million. So in period 2, when I record the sale, we debit accounts receivable, credit sales for $48 million, debit cost of goods sold for $40, credit inventory for $40, and notice I have now shifted profits from the previous year when I took that $12 million loss to the current year when I now have an $8 million profit. So you can understand why they would do this when management teams change. It's called the big bath. So why would this happen? We would say that we like to tell bad news early and we don't tell the good news until it happens. Cynics would say it's because their earnings are being managed. Now, something that's important to know. We said that in the U.S., we love LIFO, but abroad, LIFO is prohibited. So, if that's the case, that's why we saw on Walmart where they use LIFO in the United States, but they use FIFO abroad. And there's kind of an interesting backstory here, because as long as LIFO is being able to be used in the U.S., it lessens the tax burden of U.S. taxpayers. But if ever Congress was to say, oh, let's go with the rest of the world and prohibit LIFO, all of a sudden the tax windfall to the federal government would be huge if LIFO was no longer allowed. One other fun thing that you should know about is about hidden reserves. So, for example, Texaco had a lot of layers of really cheap oil in its inventory because they had been using LIFO for years. But in 1980, because of the oil glut, they cut its production. And they said, oh, we're not going to produce oil anymore. Because of that, they started eating into their older, cheaper inventory layers. And by going into their older, cheaper inventory layers and moving them off the balance sheet onto the income statement, their cost of goods sold wasn't as big as it could have been. And so, thus, their profits were larger than expected because they were able to move these cheap, older costs onto the income statement. So, some people would say that if you use LIFO, you have these hidden reserves, because if you stop producing or you stop buying inventory, you start moving those older, cheaper inventory costs onto the income statement. Thus, you're able to manage what your net income will be. So, just be aware of the hidden reserve of LIFO. To bring that point home probably a little bit better, here is a company that has two older layers. They have 500 units at $12 and 200 units at $15. We're now in 2011, and they're going to sell 900 units at a sales price of $75 each, or sales of $67,500. Also in 2011, they buy 350 units at $30, a little bit higher price than these older layers. And they have other expenses of $20,000 and a tax rate of 30%. So we're going to look at two income statements. The first income statement says I'm going to sell 900 units. And if we sell 90 units at $75, that sales is $67,500. How do I get cost of goods sold? Well, last in, first out. We bought 350 units this year at $30. We then tap into the 200 units at $15. And then we need another 350 units of this cheaper $12 layer. So cost of goods sold is $17,700. Other expenses $20,000. Net income before tax, $29,800. 30% is taxes. Net income of $20,860. But what if the company instead said, I'm going to go out on December 20th and buy another 550 units of inventory at $30 each. Well, if that's the case, then the 900 units of inventory were purchased at $30 each, which reduced my net income before tax, which reduced the amount of tax I paid, and made my net income lower, but I kept more cash for myself, just because I went shopping in December. So notice, when you buy your inventory, and if you tap into older, cheaper inventory layers, when you're using LIFO, can really have a dramatic impact on your taxes and your bottom line. The last thing I want to remind you of is we talked about operating cycle, and if there was a financing gap, and this is to refresh your memory about days inventory and days receivables, and that the operating cycle was the days inventory on hand plus the days receivables minus the accounts payable. And if the operating cycle was longer than the days payable, then there was a financing gap and you had to go borrow money. But if the days payables were greater than the operating cycle, you got free financing from suppliers. And that's all I have to say, and thank you very much for listening.